I think it's labor market data. I think it's claims, continuing claims, what we see in the monthly
Right.
jobs report. I think that's the needle mover in terms of Fed policy.
Can you
I
correlate
think
Target's earnings this morning and very great disappointment on revenue? Can you coordinate that correlate that, I should say, with the labor market?
Well, I don't cover individual stocks, including
Yeah, I
not
understand
covering
that.
Target, but you have the earnings story this quarter at the bottom line level has been better than expected. The beat rate, the percent by which companies have beaten, but you've got overall revenue growth down around in line with where inflation is. So it really has exposed the companies that actually do have pricing power and don't have pricing power. In addition, revenue beat rate has been below average. The percent by which companies have beaten on the top line has been below average. So I think this is increasingly, yet again, a sign of this bifurcation happening, whether it's between nominal and real, high-end consumer and low-end consumer, services versus the goods side, discretionary versus non-discretionary. And I think there's a reason why the consumer discretionary sector has been performing poorly, is we're now seeing more than just cracks in the facade of the consumer.
So, Liz Ann, I guess one of the key issues here are the earnings that we have seen. And again, we're going to another big one after the close tonight with NVIDIA. Have they been strong enough to support this big move up in equity valuations that we've seen since October?
Well, you've got about, I think the blended growth rate right now is 11%. That's inclusive of the companies that have yet to report. And that is well better than what was expected at the beginning of reporting season. That's getting there, but I think earnings do need to continue to surprise on the upside, because last year's strength in the market was all multiple expansion because you didn't have much in the way of earnings growth. So I think the earnings do have to play catch up. Obviously, the report out today is incredibly important, not just psychologically, which we know it's going to be important psychologically, but if you look at the overall tech sector, the earnings growth rate drops from about 24% or so, 23, 24% down to less than 11, excluding what is expected for NVIDIA. So it is obviously the poster child, but that has been the support for the tech sector, which is the overall support for a higher valuation level. If you look around the world, one of the mistakes that investors make is they do valuation comps country to country, region to region, without taking into consideration what are the underlying drivers of the local economy. And when you have more of an information tech-based economy, that is supportive, all else equal, of a higher valuation backdrop. The last thing I'd say is inflation as a backdrop for valuations is important. Maybe not coincidentally, the sweet spot in terms of historical valuations being supported at a higher level has been in and around that 2% inflation zone. We're obviously not there yet, even if we're directionally heading in the right way.